Hey, hello everyone, and welcome to today's New Capital webinar, Q1 2026, Markets React to New Violent Conflicts. I'm Catherine Barr, the Director of Communications at New Capital. If you have questions during the webinar, feel free to use the Q&A tool or the chat feature in the webinar menu. It should be at the bottom of your screen, and we will answer any questions at the end of the presentation. Before we begin today, I'm going to launch a quick poll. If everyone would take a few moments and complete that, we would appreciate it. And Leonard will be reviewing the results as he gets started with the presentation. Okay, and now while you all are answering the poll, I'm going to go ahead and read our regulatory disclosures. Okay, this New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there's also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay. Thank you for that. And Leonard, if you want to go ahead and join us, and I'll turn it over to you. We've got about 81% of the attendees have completed the poll. So we'll give people a few more moments.
Well, good afternoon, everybody. We're gonna let the poll finish up here, and then we'll take a look at the results.
Okay, so I'm going to go ahead and end the poll, and I'm going to share the results. And Leonard, can you see that now?
Yep.
Okay.
Okay, number one, how do you feel about financial markets right now? 5 out of 18, very nervous. 11 out of 18, a little concerned. And nobody feeling neutral. A couple people feel fine. Nobody feels great. So clearly skewing toward the concern area. Number two, what is the Trump administration's central war aim in Iran? Only one of you says it's to change the regime, i.e. the government. 6 say it is to stop nuclear weapons there, and 9 out of 16, over half, say it is to corner the global oil market. Very interesting. And I'm going to be talking about just that issue in a second. But note, over half of you say that the the central war aim is not either of the aims that is being stated by the administration. You're suggesting with your answer that there is a deeper, more unspoken, I would say, war aim. The president has sort of alluded to it on a couple of occasions when he said, we're there for the oil, but it's really been an aside. I would say, at least as far as I can tell, that in the official communications of the government, our government, cornering the global oil market is not an express aim. And then 3, which of the following best describe? We've asked this question now, I'd say, on at least 2 or 3 of the past webinars, and I've just decided that we're just going to continue to ask it. I think it gives a good reflection of what people are thinking. Which of the following best describes your level of confidence? 1, in U.S. democratic institutions, 1 vote for strong, the guardrails are working. 3 people are uneasy, signs of erosion are present. 4 out of 15, deeply concerned, we're nearing authoritarian risk. 7 out of 15, the largest group, saying, I'm alarmed. We have crossed over into authoritarianism. Nobody says, I don't know enough to say. Okay, thank you very much for your answers. Much appreciated. We're going to move on now to a few housekeeping items. NCM 360 quarterly reports are out. And so if you want to look at your quarterly report, then NCM 360 is the place to go to get it. As always, meeting reports, we're now producing very detailed meeting reports for you to take a look at after our meetings. And I recommend that. I think that you'll learn a lot, not necessarily learn a lot, but you'll get refreshed on what we talked about, and it may help further reify things that we're working on together if you read about it in writing and read about the meetings. We do a lot of hard work to get the meeting reports ready and cleaned up. They are coming from our AI recording software that we use, but we make sure that we go through it and make sure that the meeting notes don't have hallucinations in it and are reflective. There's cash flow modeling that you can do in NCM 360, automated reminders that we are sending out, and I'm going to talk about that also, plus the ability to request service, and then, of course, the usual organization and storage. These are just reminders. There's nothing new in those, but just reminding everybody that the system does those things. Some other announcements. Jaycee will be going out on maternity leave. That will start, she has emphasized with the tilde, approximately late May. And she will be out of the, she'll be out for 60 days, and then she'll be a little bit in the saddle from day 60 to day 90. But for all intents and purposes, our clients should look at Jaycee as being out on maternity leave for a 90-day period. And she's doing great. She'll be with us in just a second. And wow, she has gone through pregnancy the same way she does everything, with steadiness and, I don't know what the word is, aplomb, and without missing a beat. No surprise. Virtru Secure Email. I will be sending an email from me, or we will be sending an email from me shortly. It may even go out this weekend. We worked on it yesterday, but I want everybody to know that email has proven itself to be problematic with all of the hacking and phishing and things that go on. And we have had, not tons, but we have had regular occurrences with clients who've had their email hacked. And the problem is that the hackers are looking for your relationship with New Capital Management. They're looking for anything financial, but if they can find communications between us that contain information that is confidential, then that raises their listening level. And of course, they're using AI now and all sorts of listening tools. And so we are extending our use of Virtru. We've used it before, but it's now going to be mandatory. And it just means, and you've seen these before, that if you get something from an insurance company, you have to authenticate the email itself to open it, and we're going to that. So I'll be describing that, but I want everybody to know that we're increasing our level of email security here at New Capital. It's for your benefit, and we're just going to ask you to cooperate. You know that it's in your interest, and we'll give you details about that. The other thing, of course, is we have NCM 360. We've built our own platform. It's actually the most secure way for us to leave things for you, and we will continue to design the ability to exchange files and leave messages and so on, NCM 360. That's something that's on our drawing board here for 2026, and I expect that by the end of the year, at least, if not sooner, we'll be able to do more there. But that's why we encourage you to get to know NCM 360 and use it, because it really is more secure than email. But we are going to be using this Virtru piece also, because we know email is here to stay. Everybody relies on it, but it's just going to have an extra layer, and that's Virtru. we are going to be changing our webinar software. We're all using Zoom for today's, but we're going to be going to something called Demio. We've researched it. It's just better. And so our next webinar, which will be the next quarter, which will take place, I guess sometime in July, mid-July, it's going to be on Demio. We've already signed the contract for it, and it'll be my first time to use it. It's going to be yours. We hope everything's going to be smooth, but I'm just telling everybody now because those who attend our webinars tend to attend the webinars regularly. So this is the group I'm telling here. We're both going to get experience with Demio at the same time, and hopefully it'll go smoothly. We think it will, but be patient with us on the next webinar. We may have some glitches we have to work through, and we will. But we think the experience is going to be easier and better. It works through your browser. So you'll be seeing our webinar in your browser, which is the way that Microsoft Teams works for a lot of people, and also the way that Google Meet works for a lot of people. It works the same way. Okay, and our annual conference, we have set a date, October the 28th, Wednesday. So please mark your calendar, and we'll, of course, begin to send out more invitations later. Okay, to get into the heart of the presentation now, just to do a review from our last webinar, I wanted to put these back in because the things we developed for the webinar that we did back in January, they still stand. They were 2026 forward-looking things. And in that webinar, I talked about that at least here in the United States, we're going from rules-based governance to power-driven economics. That's the general overall observation. We have executive power unbound. Emergency authority is normalized. Courts, Congress sidelined. We've had state coercion of labor, mass arrest, detention, imprisonment, and deportation of workers, and that includes some legal residents. I highlighted this expropriative foreign policy, force, seizure, and leverage are replacing treaty-based norms, and that really has been the theme of Q1. It began in January with Venezuela and has expanded to the war in Iran. And the difference isn't that we've had conflict. There's been conflict with Venezuela and there's been conflict with Iran. Those conflicts have existed. The difference is that violence is the difference. And that's why I titled today's seminar the way I did. I put the word violence in there because violence changes everything, right? Before violence, certain things are possible. When violence is introduced, things may or may not be possible. And I also want to say that we at New Capital regret the loss of life of anybody from violence, including in the current spate of violence. But I highlighted this because this really is the theme of Q1, is this expropriative foreign policy. Personal enrichment by government officials, policy is aligned with financial interests, and government is market actor, favored firms directing outcomes and politicizing capital. These other non-highlighted things have sort of taken a back seat in the first quarter, but it doesn't mean that they're not going on. It just means that they're not making the headlines. And the investment implications for this were that governance risk is now domestic. Here in the United States, what we used to see as a risk that did not apply to the United States is now a risk in the investment picture. That volatility is structural, it's not cyclical. In other words, volatility is built into the system. And I think we can all sense that and feel that in the way that markets have moved suddenly here in the first quarter. The diversification includes jurisdictional risk, that we can't just look to diversify by industries or companies, that the area of jurisdiction also has to be looked at as something that we try to achieve diversification in. Asset classes, and I'm going to skip this one. The environment for this year, I said back in January, would be less stable rules. The response would be diversification. We would have faster shocks. Liquidity would be an appropriate response to that. We would have directed markets, and so we would be selective and make sure that we didn't get caught up in any market that would be vulnerable. and that we also here in 2026 that we would be seeing very, very significant productivity leaps. And the response there is firm innovation. We have been doing that ourselves, innovating, and I think that most businesses also are innovating. So this is the environment. And I talked about in 2026, and this is just a review. NCM portfolios and services are built for this new world. We have global portfolios. We have liquid overnight portfolios. They are tax efficient. We offer access to custody outside the United States and Switzerland. Securities loans are advantageous there. We can borrow very, very inexpensively through our Swiss relationship, 1% to borrow, almost nothing, versus 5% here in the United States. We continue to offer services through Henley and Associates of residency and citizenship if people are interested in that. And there are some clients who have gone into investigation mode around this residency and citizenship by investment. Certainly not the majority, and certainly not anywhere near any sort of plurality. But I would say a couple handfuls of clients have been interested in this area. And then relocation and evaluation planning. We have had some clients who have decided to move. And then, of course, NCM 360 as a place to keep information and to make sure that it's secure. Okay. Getting back to expropriation and to the poll, where most of you said that 56% who took the poll said, we think this is about cornering the global oil market. This is work I started to do during the first quarter, I would say early in the first quarter. And note that I've labeled this slide an NCM exclusive because it is my slide. And let me just orient you that each column has all three of these elements. It gives you the global population in percent. It also gives you global proved reserves in percent and global production in percent. This is the U.S. over here on the left, plus Venezuela. Venezuela is now essentially, and its oil supply essentially is now controlled by the United States. Anyone who doesn't think that's the case, I'm sorry, I don't know what to tell you. But it is, and it's controlled by the U.S. Navy and U.S. hegemony. And so we can basically put U.S. and Venezuela together now after the essentially conquering of Venezuela that took place in early January. And you can see that as a percent of the world's population, the U.S. population opposed to the Venezuela population, this yellow is very small. And you can see that the percentage of global oil reserves approaches 25%, right? Maybe 27%, the distance between 25 and 50%. And similarly, the percentage of global oil production. Now, most of the production is U.S. production because the Venezuelan production is very degraded after years of sanctions and mismanagement and so on. And so there's room for this production to rise. Most of this production is U.S. production. But you see that the U.S. and Venezuela together, this is very big, about 25%, call it, of U.S. reserves and production. Now look, if we add Iran in the picture, right? If the effort in Iran really is about gaining control of Iran's oil reserves, if that's what was being talked about in the deep Oval Office meetings in the planning stages leading up to this war, and I, for one, think that it was, look at the picture. Now you see that global proven reserves expand very, very significantly. You get some increase in global production. It's a meaningful and significant increase. The blue here versus the blue here. But you see the red really, really jumps up here. And so if the U.S. is able, or had been able, whatever word you want to use, to gain hegemony over Iran, and of course, what has been standing in the way of that is the Iranian response. The Iranian military response has been standing in the way of that. The U.S. and Israel took out the top leadership in the first minute or so of the war, but it's become apparent that the Iranian government and political institutions there managed to create succession, strong, credible succession that has outlived the deaths of the leaders. And as a result, rather than conquering Iran, the U.S. now finds itself having to negotiate while hostilities continue. But if that goal, if that was indeed a goal, had been achieved, you see what would have resulted in global production over 25%, and global reserves would have leapt up. And yet the percentage of the global population that controls this large amount of reserves and production still very small. Now, we add in the GCC, the Gulf Cooperation Council, which is the bloc of largely Arabian countries, Saudi Arabia and Oman and the UAE and Emirates, which are, for all intents and purposes, U.S. allies. If you add them into the picture, you have, look what you have. You have almost 50% of U.S. 50% of global oil production. And you have well over 50% of global proven reserves. You have what I am calling a super block. And yet you still have hardly a budge in the global population. This, in my view, is the strategic goal of this war. It is to produce a global superbloc, what we might call cornering the global oil market, or certainly having an oligarchy, an oil oligarchy, sitting at the top of that with the U.S. Navy and the U.S. military, the President of the United States, who becomes immediately the most powerful person in the world, who already was the most powerful person in the world, but this accomplishes it on a really, really astounding level. Now we can ask, is this the role of the United States to exercise military power in this way? But I can pretty much guarantee you that the answer from the White House is yes, it is, absolutely. Now look what happens next if we move on to China. Here's China. China has some production and some reserves, but look at the population. Look at the reserves and production in comparison to the population of China. And look at India. An even more difficult picture. Hardly any oil production and reserves, and a very, very large population, and Europe in a similar boat. Look at these three countries, China, India, and this is not a country, this is a bloc, but the European 27 are really in a tough place from a petroleum standpoint. And it explains why China and alternative energy and clean energy is such an important thing for China to develop, and they are developing, and also explains why coal as a means of generating electricity is still very, very important to China. Look at Russia. Hardly any population compared to as a percent of global population, but very, very healthy reserves and production compared to its population. You can see Russia is an oil power. And here's the rest of the world. Look at the size of the population, and this would include places like South America and Africa, right? Not bad. You got the rest of the world with half of the world's population, but also something like 20-something% of production and maybe 25% of proven reserves. But you see, these are the guys really in the tight spot. Okay, I hope that's helpful. Now, here's the other slide. Gemini helped me made it, Gemini AI, and this is showing you that the technical threshold for what we would call market dominance, i.e. cornering the market, is around 60%. This is the technical term, the way economists look at market dominance or market cornering. And you see that this U.S.-led super bloc, around 62.5% of proven oil reserves, just gets over the threshold for defining market dominance versus the rest of the world. We have a geopolitical leverage gap. The superbloc is 6.3% of global population and represents 62.5% of global oil reserves. The pivotal supplier mechanism, the rest of the world can no longer meet global demand independently. The superbloc has moved from a market participant to the market gatekeeper. And I assure you that within the White House, within the Pentagon, within CIA, within National Security Council, this is understood. It's not understood, I'm not sure, among the US press. It's not understood, I'm not sure, among US citizenry, but it's now understood by new capital clients. And I'm happy to give you this information. The result, of course, for global oil prices, bingo, a big jump up. Here we were in 2025, everybody going about their business and whammo. But you see that the price of oil has precedent. During the early days of the war in Ukraine, a long period, people forget this, between 2011 and 2015, we had elevated oil prices for 3 to 4 years. Look at that. It's hard to remember, but oil prices back then, right? Nobody remembers that, but look at that. And here, right before the global financial crisis, we had a spike in oil prices. Look, a steady climb for several years in the price of oil. And so the question is, how long, right? We've seen these prices before, but the question is, does it do this or does it do this? We don't know yet. Wars in the stock market. Everybody wants to know. Okay, well, when we have wars, what does the stock market do? Well, depends on the war. World War II is here, and Korean War is here, and the Gulf War. And so you can see that in the trading days, 5 years, 6, 7 years on from the beginning of the war, that the stock market did just fine. Other wars, Vietnam, worst of all, Afghanistan and Iraq, the market in the years after these wars, not so good. Now, we can't assign causation to the stock market. There may be other reasons why the stock market did well during this period. Maybe we had high productivity during this war. I'm just showing you that just because there's a war doesn't mean the stock market can't do fine. That's the point here. Not that the market did well because of the wars, okay? I'm just showing you that in general, the market has shown an ability to do okay, coincident with, let's say that, with the wars. Okay, everybody? Now, that concludes my first period presentation. I'm going to turn to Jaycee now for what has become her usual presentation to show you, okay, fine. You've talked about how you see things. You talked about how you were seeing things back in early 2026. You've reviewed that. You've talked about the general backdrop here. How have new capital portfolios done? If you put your money where your mouth is, what does it look like? And Jaycee's going to talk about that. So let me welcome Jaycee onto the webinar, although I can't see her. All right.
Okay.
And then
Here we
Jaycee,
go.
I've got to advance the screens.
Okay, perfect. Thank you. And good afternoon, everyone. So I'll be sharing my normal model performance over the previous quarter, some year-to-date numbers as well, because it's pretty interesting to see the difference between the quarter performance and year-to-date performance. So let's take a look and see. Okay, so Q1 of this year, these are our normal portfolio models here. So we've got our global core with the small and value factor tilts, the global market, international with without the increased small and value tilts, the U.S. core, those as U.S. only portfolios with the factor tilts, and then U.S. market are the U.S. only model portfolios without those tilts. And so how did each of these do over this first quarter? You can see largely most of them were flat or down. So bonds were pretty flat, but as you move along the scale here, model 10 all the way being the 100% equity portfolios. You can see gradually equities had a bit of a rough time, by and large in the US market. But if you look in the blue, our global core portfolios, this is what I would say our kind of standard portfolio that most clients are in. We actually were able to put up some positives here. So that is the good news over the quarter. So the small and value factor tilts definitely played a large role. There's, additional exposure to the energy sector in these companies. And so that's where we're seeing some of the positive outcome from the US
Jaycee,
market.
Jaycee.
Yeah.
Okay, let me jump in here. I want to spend a little time on this slide. It's very, very interesting.
It is.
First of all, we observe that the global core all stock portfolio outperformed the all bond portfolio in the quarter, right? So we can't automatically, no one should automatically assume that bonds outperformed stocks. It may have for these portfolios, right? Bonds may have outperformed and they did, right? So this portfolio outperformed this one. The red here outperformed the red here.
Right.
But the blue here did not outperform the blue here.
Very interesting.
Right? That's a fascinating, you just don't see that very often.
Mm-mm.
That's how resilient this global core portfolio was in the first quarter of 2026. Not only did the stock position, and that is due to, I want everybody to understand that our portfolios provided you with meaningful diversification against an oil shock. I'm not going to tell you that, your portfolio performed as if you were holding 100% Exxon stock or Chevron, but that's not our job. We gave you very, very meaningful protection against the oil shock in your portfolio is the observation. And then the observation is that most of our clients, by far, very few hold these other variants because most clients want what we think is the best all-purpose portfolio, I would say. Meaning most clients, the blue performance was your performance, whether you're in Model 0 or Model 5 or Model 8 or Model 10, that's, depends upon where we've put you. But most of you are in the blue. And look, you had a really, really, I think, positive experience in the first quarter. I'm hoping that's what you all will think. Okay, should we go to the next one now?
Yeah, let's take a look.
All right.
So the next one is year-to-date performance through yesterday. So this is just 2 weeks beyond the slide we just showed you. And you can see now that all of the portfolios are in the positive. So just over the past couple of weeks with talks of, ceasefires, peace talks, the the market has rebounded pretty significantly. But again, our blue global core portfolios have really outshined compared to, the global market, US core, US market portfolios. So someone in a Model 5 might have seen, over 4% return year to date so far.
Versus somebody holding the S&P 500 would have seen a little over 2%.
Yeah.
So if you are a 50-50 investor and you had held only the S&P 500 as your stock allocation versus working with us at New Capital, you missed 2% in your portfolio. And if you held a Model 10 portfolio in the first quarter, right, the difference is even bigger, 7% versus a little over 3%, almost 4 percentage points in difference in someone who was a 100% stock investor and held their stock investments only in something like the S&P 500.
Right.
Okay.
This chart is showing our performance, and we're using our global core portfolio as the model that we are comparing to our partners. So the same that we usually do, BlackRock, Vanguard, and Dimensional. They all have their model portfolios, and we like to track our performance compared to them over time. So for this example, we're using the Model 5, so a 50% stock, 50% bond portfolio. NCM there in green So you can see again, we are a little positive there for the first quarter, but the only one here positive for the first quarter. So BlackRock down, almost 1%. Vanguard down 75 basis points. Dimensional just down a little bit, but our portfolios compared to partners for this quarter did their job.
Okay.
This is showing our US versus international equity allocations. We show this every time in our webinars, but we've made another change over the past quarter, and so we want to show you where we are now. So new capital, we are 50% US, 50% international in our equity allocations, compared to BlackRock 75%, 25, Vanguard being the closest to us 60-40, but we still have much more overweight to international than they do. Dimensional 72-28. And then the ACWI is now crept down just a little bit from about 64%. It's now 62% US, 38% international.
And this which indicates that there has been some revaluing going on globally toward international in the ACWI benchmark, which is a very popular global benchmark.
Right.
So versus the ACWI, we are 12% underweight the US and 12% overweight international. And we've talked about why we have favored that, largely on valuation reasons, not geopolitical reasons, although those exist too. Largely it's been because we can find less expensive assets globally. And we think that's been a remarkable opportunity, and we have acted on that. So is this the yeah? Oh no, we're not done with it yet. But okay, let's go to model changes. That's next.
Okay.
So there it is. There's the change.
couple changes here that we made over the previous quarter back in late January, early February. The first we just talked about, we increased our international equity to 50% from 45%, so about additional 5% weighting there. On the fixed income side, we reduced US Treasuries from 33% to 20% of the fixed income sleeve. And we moved that allocation into these two new funds, JPIB, so JP Morgan, actively managed, broadly diversified multi-sector international bond fund, and LQD, which is a diversified corporate bond fund that invests in investment grade corporate bonds.
Let's talk about that change a little bit. It's an important one. There are a lot of people concerned about the fiscal stability of the US government with deficits, the debt deficits that now run close to $2 trillion a year, and debts accumulated of almost $40 trillion and counting and rising. That's a topic for another day. I have a lot to say about that, but I'm not going to say a lot about it today. But the implication is that the U.S. Treasury bond isn't necessarily a risk-free instrument anymore. If you go to business school, I did, maybe a lot of you have been to business school or studied finance, the U.S. Treasury bond has been considered to be a risk-free instrument. It's the bond to which all other bonds are compared. If the interest rate on the U.S. bond is this, others will have a more expensive interest rate. It's really no longer the case. And as a result, we were uncomfortable that U.S. Treasuries would represent 33% of the bond portfolio. It made sense coming out of COVID, and it's made sense at other times when there's been a flight to safety. In 2008, most notably, the only asset to put up positive returns in 2008 were U.S. Treasuries. But we're seeing signs that the United States is no longer viewed as a automatic safe haven. Many of you know that gold has run up last year, and it's been a period when investment managers have searched high and low to find safe havens. we still have a major commitment to U.S. Treasuries in the portfolio. It's hard to get away from it. It dominates the bond market to such an extent, but we have made a very significant reduction in that part of the fixed income sleeve for those reasons. Okay.
And our last change to our tactical alternative sleeve that we put into the portfolios last year was that we have a new addition where we did add gold to the portfolios in a very small allocation, about 2% of the overall tactical sleeve. So depending on, where your model portfolio is, how aggressive, how conservative it is, the more aggressive, the higher allocation to it, the more conservative, the lower allocation. But we did go ahead and make that adjustment and added gold earlier this year.
I sort of did it grudgingly, I would say. I didn't do it because I think there's a whole lot of money to be made more in gold. I have no idea. Maybe there is. I'm not a big gold investor, and I never have been. I've talked before about Warren Buffett's views about gold. Take that for what it's worth. But gold has shown some ability that when all hell breaks loose, to have a counter veiling performance to it. And that's why it's in the portfolio now in a very, very small amount. Gives a little bit of shock absorber because I assume hell is going to continue to break loose. That's the safe assumption at this point. And so we put it in for that reason. It could go down. It could lose half of its value. Gold, it's very volatile. It isn't going to hurt anybody very much because, again, as Jaycee pointed out, it's in a very, very small smidgen in the portfolio, but it's there. Okay. All right, Jaycee, this graph's interesting.
So we just wanted to show you the individual U.S. and international stock funds that we hold in our global core portfolios and where they're at year to date. So this again is as of yesterday, at the close of yesterday. The red line here on the graph is the international fund that we hold in that portfolio, up about 11%. And then the blue is the U.S. Fund that we hold, 4.62%. So we're continuing to see that spread that we saw through 2025 with international stocks outperforming U.S. stocks. And so we just want to make sure everyone's aware if they're not already, and we continue to see that spread.
And you see, everybody, that the outperformance widens in some periods and closes in some periods, and it just that's been how the year has gone. Some widening, some tightening, and we'll see what the remainder of the year brings. We make no predictions.
Mm-hmm. And then our last slide here, we just wanted to show you gold's year-to-date performance. IAU is the iShares fund that we are using for the gold allocation. So year-to-date, up about 11.24%. So it had a big run up in 25, but it's continued here to the start of 2026.
Yeah, but everybody
Big
can
peak,
see that. Yeah, look, go ahead, tell them, Jaycee.
Big peak right before early February. Dip at I don't recall what the beginning of February was because the war was late February. So
yeah, and then a run up in it, and then it's just
yeah.
Even though the war has been going on, gold has not provided a defense against the war itself.
Yeah.
So we can think we know how some asset class is going to react, but there's never any guarantee.
Right.
We never give you guarantees, everybody, that gold is going to react this way. You just never know. We do our best. Okay. Current market conditions. Let me get through these. These are a lot of the usual slides that I bring to you from, they're produced by JP Morgan. This is inflation, just to show everybody. Here in the most recent observations, we can see energy inflation right here in green, which really ran up right here in the COVID period. Look at that, right? And then fell off, right? Oil prices backed off, but look, here we're starting to see right here this slip in, and it is accounting for a rise in the general inflation rate, right? Things were going along here around a little under 3%, and it's this energy inflation right here that has jumped up general inflation above the 3%. And who knows? I don't know where the next reading goes, but we will find out now that we have oil prices well above $3 certainly, in many cases $4. Let's get back to tariffs, right? Nobody hears about tariffs that much anymore. The Supreme Court came out with its ruling that the tariffs as applied were unconstitutional. The reworking of the tariffs by the Trump administration to say that a country is going to have a high tariff because of national security concerns, and you see all the national security concerns that that are there, and the April 2nd announced tariffs a couple weeks ago under Section 122, that is the national security concern. You see the national security countries: Vietnam, Sri Lanka, Bangladesh, Cambodia, Thailand, Indonesia, Pakistan, Malaysia, Taiwan, Switzerland. Did you know that our country is facing national security concerns from South Korea and Japan and the European Union and even Israel? Well, we are. We face national security concerns, and as a result, these Section 122 tariffs are in place, some of them very, very onerous. Look at that. Cambodia facing up to 50% tariffs from the new replacement tariffs. However, these Section 122 tariffs have a fuse on them. They only go for, I think it's 6 months. And so that's the difference. The Section 122 cannot be applied indefinitely. And I think the Trump administration is going to have to make their case that they can be continued, and I'm sure they will try to make that case. But in case anybody thinks tariffs have gone away, think again. And then here is the general picture on tariffs. This was the Liberation Day, April 8th application, when the general tariff rate was 30%. This is the IEEPA decision, the Supreme Court. Tariffs by that point had fallen to around 16%. Through various negotiations and rescinding and changes of mind, et cetera, et cetera. And then here, April 14th, just a couple days ago, have settled around 12%. So that's the tariff picture. Here's the federal finances. I was just talking about that with regard to the treasuries. And you can see that the deficit, $1.8 billion, the failure of our government to assess taxes sufficient to meet the budget over here on the left is now $1.8 trillion. And we, Jaycee and I, decided we just didn't want you all to, in your portfolios, to be the ones that automatically step into that breach with your portfolios and purchase U.S. Treasuries automatically to such an extent. And so we reduced your participation in funding that deficit. But you can also see customs duties. This is tariffs. Look, they really have risen very quickly to be a substantial part of the funding of the United States government, equal to corporate taxes. Corporate income taxes now are equaled by tariffs. So the customs tariffs are being paid by U.S. consumers. They now equal the amount paid by corporations on their income taxation. And then the rest is payroll taxes, workers like, well, me and Jaycee, and income taxes, taxpayers like you all at home on our call today. Okay, S&P, where are we? 20.5 times earnings. We've had a long rise interrupted by this big drop right here last year around Liberation Day, and we're trading around 20.5 times earnings on the S&P 500. Not unprecedented. We've seen other peaks, 21.4 times, and here's a peak at 19.2, and way back here in 2000 in the tech bubble, 25.2. We're certainly at an elevated but not unprecedented level of valuation. We're certainly not where we were in 2009 on valuation. 10.4 times earnings. Here's a trough, 13.3, 15.7. So we continue to trade at expensive valuations, and you can see that here as well on the usual chart that I show. We are, let's see, we are one standard deviation from the 30-year average of 17.2, one standard deviation, but we've come in some from this higher reading that we were seeing earlier in the year. We have come back some. This is an interesting chart. I don't think I've shown this one before. It's sources of earnings growth and profit margin. So you may say, well, is this for real? Are the valuations for real? Is the strength and ongoing holding up of the stock market, is there any basis for it? This chart says, well, you kind of, yeah, look, the S&P 500 profit margins, quarterly earnings divided by sales, has continued to rise from 2008 and has reached an all-time high in the 2000s, 14.1%. If you take the earnings and divide by the sales of the S&P 500, this shows that U.S. companies are very, very healthy in their profitability. And folks, that will overcome just about any war and any worry and any president. I'm just going to say it like that. Consumer sentiment and the stock market. Consumer sentiment is actually quite low. Look at that. Really, right now in April of 2026, consumer sentiment is hitting the sort of lows that we've seen only a few times. Very, very poor consumer sentiment right now. The thing is that when we've seen consumer sentiment that's very, very poor in the past, it's often led to subsequent performance in the stock market that's actually quite positive. And so consumer sentiment is one of those things that's looked at by market watchers as a counter indicator, a contra indicator. It doesn't automatically mean that if we have poor consumer sentiment, we've got a bad stock market. A lot of the times it's meant the opposite, that out ahead of us could be a positive stock market. No guarantee. I'm not saying that's going to be the case. Don't misunderstand me. But I'm just showing you what the historical chart has meant. Average subsequent 12 months S&P 500 returns from peaks. These peaks, the return has been only 4.8%, but the return from 9 sentiment troughs has been 24%. So, it's not an indicator that we should just, discount automatically. Returns and valuations by style. This is year to date, and you can see that the growth area of the stock market that has been the engine, NVIDIA and Apple and Microsoft, all of those, has fallen off the pace here in early 2026. Don't know what the rest of the year will bring, but this is what it's brought year to date. Even blend companies, Coca-Cola and PepsiCo and so on, 2.1%. Mid-sized companies that are growth companies also putting up negatives for the beginning of the year. But look at the rotation into small companies across the board and value companies across the board. Look at that. And guess what? That is exactly where your portfolio is positioned by New Capital Management. Okay, I think that's the main point. Well, one more point I'll make about this slide is that even so, if you look at the current valuations, which is, I think, easiest represented here, most quickly represented here, you can see that nothing is trading under 100% of its 20-year price to earnings average, the forward PE, the going forward PE, meaning if we look at the 20-year average, nothing is trading below that and below 100%. Everything is above it, some more than others, 127% on the large company growth part of the market versus, only 105% on medium-sized blend companies, but not one of these readings is below 100%. Again, to emphasize, we are not in a cheap stock market in the United States, any way you cut it. But if we look at the rest of the world, you might ask, well, is your international view run out? Has the lemon been fully squeezed on the international returns? I think the answer would be no, I don't think it has. You can see that the U.S. trading up around 20 times earnings, and we've just looked at the slides on that. Japan, 16 times earnings. Europe, 15 times earnings. Emerging markets, 13 times earnings. And China, 12 times earnings. So in the international sphere, you can see that prices are still much more favorable. And you can see that by sector. All of these sectors, with the exception of healthcare. In the rest of the world, the companies in the same businesses as the United States companies, industrial companies, for example, in the US, and industrial companies in the rest of the world in general, the industrial companies in the rest of the world are selling at a discount to what US companies in the same business are selling at. I think that's compelling. If I want to buy an industrials company, I can buy it a lot cheaper outside the United States. Given prices in the United States, we're happy to do that, and we have been doing that for you. Okay, just a couple more slides, and then we'll take questions. CapEx, I'm getting to AI here. You can see the rise in the spending by the hyperscalers, Alphabet, Amazon, Meta, the guys building the data centers. Look at that. 19 and 20. Look, it's just da 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 da, and then whoosh. 2024, $241 billion. 2025, almost double, $416 billion. Here in 26, we're expected to see $677 billion, right? That's over the amount of tariffs that the U.S. is collecting by 1.5 times, over the amount of corporate income tax that the U.S. government is collecting by 1.5 times. But you also see it's kind of starts to moderate here from the estimated standpoint. 2027, it's starting to, we'll see. Things are starting to get a little less. And this chart on the right shows you the free cash flow, operating cash flow of the businesses, the hyperscalers, less what they spend on capital expenditures. What you can see is that going back to 2004, when they were cash generating machines, whoo, look at this. They are spending, 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 and they don't have all this excess cash flow to do other things with, pay a dividend to you as a shareholder, or acquire other companies, or do internal R&D, right? They have been spending on building this out. Now, we can argue, is that a good thing or not? These charts are just designed to show you that's what they're doing with their money, is putting it into AI. And this next slide, implementation of AI, you can see the absolute acceleration of the releases by the major providers, Claude, GPT, which is OpenAI, Gemini, which is Google. These are the big guys. You can see the absolute acceleration of their releases as they go head to head to try to put out new releases of the improved AI version of the day for them. And then on the right, you can see that businesses are still in the early days of implementing, even in professional and technical, which New Capital would qualify for. But I can tell you, we are implementing AI across many areas. We're in this 36% who have implemented it, continue to implement it. But that means that 2/3 still, at least according to this reporting in this chart, are not using AI in any business function. I suspect their employees are. I can bet you dollars to donuts that their employees are, but whether the companies are putting it into their businesses in an organized and compliant fashion, that's a different story. But you can see that that is the sector where the most penetration of AI is, in these information and professional technical. You go down these, and I've shown this slide before, retail trade, construction, wholesale trade, manufacturing, they are just scratching the surface. But I can tell you, it is coming to all of these businesses, and maybe coming soon. We'll see. Okay, just a couple of more slides, and then I'm done. This is interesting. We include real estate in your portfolio. It's a small piece of it, but I wanted to show everybody real estate really hit the skids between 2022 and about now. You can see that this is showing private real estate returns, but during this period, while the real estate was paying income, right, it was making dividend payments of rentals, the prices of the assets were declining. The capital on the real estate, the invested capital in real estate, was incurring losses, some quite significant. In 2023, 10% losses, which more than offset the income that was being received on rentals. And therefore, there was a net loss on real estate during that time period. We have stuck to our guns on real estate, and especially now, we think it's not a bad place to have in the portfolio, to have a real asset and some defensiveness, and it has given us some defensiveness in the portfolio. And I'm glad we stuck to our guns, because you can see that the workout has occurred in real estate, and we're starting to see appreciation, very modest, very early, but you see a little bit of orange peeking out here in the real estate area, where we're starting to see some appreciation in the value of commercial real estate going along with the income that is being received. And so we have stuck to our guns on real estate, and this is showing you why we did. Okay, that's it. Happy to take questions if there are any.
All right. Oh, we got a good question. I don't think you'll be able to answer it offhand unless you've got a great memory, which it probably is. How has the trust in the government polling question changed over time? That is probably something I will have to go.
Oh, I don't know that. I don't know that. I have a strong suspicion, because I have seen the survey results. I am pretty sure that the empirical evidence by those who are taking surveys, and they do take these surveys, I'm pretty sure that the polls say that the trust in government, in particular areas of the government, even these polls will get down to, what do you think about Congress? What do you think about the courts, et cetera? What do you think about the executive branch? That we have seen a steady, consistent erosion in trust in government. I don't think that's going to surprise anybody here in the United States of America in 2026. But I want to make sure that everybody sees that you cannot fix a problem that you cannot identify. I can remember growing up, I would tell my parents that I saw lots of problems in our country. I didn't mean it in any unpatriotic way. I felt that I was saying it in a clear way. That's the person I am. I just try to do my best to tell it like I see it.
I actually did pull up
Okay.
results from January. So this was January. We had one extra, because this was earlier in the scenario. We added an extra option this time, which was we're in the authoritarian state. So back then we had strong guardrails are working, uneasy signs of erosion are present, and deeply concerned nearing authoritarian risk, and then an I don't know enough to say. And the deeply concerned we're nearing authoritarian risk was 82%.
Okay, but I think Rob asking about our survey or national survey?
I may be off. Do you see lesser?
I think Rob may be asking about maybe not. Oh,
Question
no, he
3,
is.
yeah.
You're right, Catherine. My apologies. No, he is asking that. Okay.
So just to continue on that, it was 82% voted deeply concerned, 2% said uneasy, signs of erosion, and 9% said uneasy and 9% said strong. So 2 votes for each of those, and 0 said I don't know enough to say. I can absolutely also follow up with the actual changes in percentages and votes, because I think that'd be interesting as well.
All right. I think that's a good idea. We'll spreadsheet it, and maybe we'll get something off to everybody. I think new capital clients have been concerned for a while in the main, and I make no judgments about that question. Everybody's entitled to their own opinion. That's fine. The only problem with authoritarianism is once it's too late, it's too late. Right? I mean, that's the problem. If you're in it, you may not get out of it. We don't say that about strong democracies, right? If you're in the strong democracy, you're stuck. That's the problem. And so that's the danger. If you don't think you're in it, but you're in it, it's kind of like not knowing that you're, stuck out in the desert and you've just kind of been walking around, yet the engine has died and you don't know it. You're still walking around out there and you don't know it till you get back to your truck and now the sun's gone down and cell phone's out. So that's kind of the problem. Okay. Okay. Yeah, let's get to the next questions.
Okay. How do you see gold as a hedge against the erosion of the US dollar as the reserve currency for world trade?
Okay. I remember what I was saying before I get to that one.
Okay.
What I was saying is you can't fix a problem unless you can identify that there's a problem. And I can remember telling my parents growing up that I thought there were problems in the country, and they really did not like me saying that. They were of the generation, firmly in the baby boom generation. I don't know if my parents are on the call today, but I can say this, and I don't think they'd have any problem with it. They were from the generation that grew up being told this is the greatest nation in the world, and that's what they were raised on. And then the Vietnam War happened and other things. And so I grew up in the 1970s, and my view of things was different. I'm from a different generation, but I would say to them, I see problems here. Whatever they were, this, that, or the other, and they really did not like that. They weren't really able to metabolize that. And where we are in 2026 in the United States is that you don't get a lot of argument now among people that there are some problems. That's good news, right? There's no problem in the world that can be fixed if the problem cannot be identified as such, as a problem, right? So I want everybody to consider that. All right, now I'll take on this other question.
Do you,
Do you see gold as a hedge against the erosion of the US dollar as the reserve currency? Maybe it is, but our portfolios themselves are designed to be the hedge. I want to say that again. It's really, really important. The portfolio we give you, it is designed to be the hedge against inflation. It is designed to be the hedge against loss of value of the dollar. It is designed to be the hedge against high oil prices. It is designed to be the thing, the entire portfolio, not just components of it. The new capital portfolio, like any investment portfolio, is designed to provide hedges all over the place. I can't guarantee you that it's going to do that. We do our very best to do it. And in the first quarter of this year, it did a really, really good job. I think everybody's clear about what we did in the first quarter, our portfolios. They were excellent. I don't think I'm breaking any compliance rule here in saying that. They did excellent. They beat the models of our business partners, who are the biggest in the world, Vanguard and BlackRock and JP Morgan and Dimensional outperformed their portfolios, but there have been periods when they have outperformed ours. They outperformed indexes, etc. This was a golden. You want to talk about gold? This was a golden quarter for the portfolio. So, can gold serve as a hedge against the erosion? Yes. We hold some Bitcoin in the portfolio. Could it serve? Yes. Could stock holdings serve as a hedge against the erosion of the US dollar? Yes. So my answer is yes, but I can't afford to look at gold as the sole hedge against problems with the US dollar. The portfolio we're giving you, because, for example, we hold global bonds more than most other advisors. We hold global bonds in the portfolio and we hold unhedged global bonds in your portfolio, so that if there is an outperformance by foreign currencies, as there has been, versus the US dollar, you participate in that. And you have. I hope that answers the question. I just don't want anybody, if I say, yeah, gold might serve as a hedge or is serving as a hedge, certainly it did serve as a hedge last year. The US dollar really had trouble last year, and gold did great, really great, fantastically. That nobody leaves the webinar thinking that, okay, the hedge against the US dollar is gold. I don't want to leave that impression. Okay, next question. Catherine, what's the next one?
I'm sorry, I forgot I was muted.
No problem.
I've got another one hitting on AI. It says some industry insiders are calling artificial general intelligence potentially the most destructive technology ever invented. What's your response to this claim? The risk of AGI's deadly unintended consequences makes the Manhattan Project look like a high school chemistry experiment?
Well, technology has always brought upsides and downsides, always. The ability to nap an axe head with uh, flintstone and make an axe way back when in the Stone Age gave people the ability to process meat or defend themselves, but also to commit murder much more easily, quickly, and so on and so on. Um, atomic energy produced, as the questioner notes, the atomic bomb. It also has produced the ability to create electricity and energy without emissions. It does make nuclear waste, which is a problem, but it is emissions-free energy. And I think it'll be much the same with AI. AI is having, and I've talked about this, a very dramatic effect on how I operate, both within New Capital and in my other parts of my life. A very, very dramatic impact. And I would say, by and large, that impact is almost all to the good. I'm hard pressed to think of an application I've used it for where it has not been helpful to me. In some cases, breakthrough helpful. In other words, it's helped me in a way that I could not have helped myself, even with extensive effort on my part. So, but I'm not using it to attack other countries. I'm not using it to target people in wars. I'm not using it to control nuclear arsenals. I'm not using it for any of those things. And so I take the point. And it may be that it turns out to be dangerous in the ways that the questioner is asking. And that's why it's incumbent on all of us as human beings, all across the world and all across the globe, to be peaceful. Peace is what enhances capital. Peace is what builds capital. Peace is what preserves capital. And in an argument that's going on between the President of the United States and the Pope, I take the Pope. I'm just going to come out and say it. I look at it the way the world looks at it. As the way the Pope looks at it. Blessed be the peacemakers. We have too much war going on. I think all the time of the destruction that is going on of structures. Let's leave aside lives. I'm kind of a DIYer when it comes to my house, and I like to fix things. I'm pretty good at it. I can tell you what aisle things at Home Depot are located on. And over the years, I've gotten to know how to do things, and I like it, and I get a good satisfaction when I can fix things. But I can tell you, anyone who has spent an afternoon on a home improvement project knows that when you drop a bomb on a building, you are wiping out the efforts that humans and machines and building supplies and shipping took them unbelievable amounts of time. I'm watching buildings go up all around here, our buildings in the River Oaks area, and I'm watching these fancy high-rises going up across the street, the RO, and there's another one, and they ain't putting that thing up in a day. These are enormous, enormous efforts. And to think about dropping bombs on the thing that just got built, I'm sorry. I just can't go there. There's got to be better ways to solve problems. And when we get to violence, which of course is the title of this talk, when we get to resolving conflicts through violence, you lost me. Period. And we're running our portfolios that way. We're making sure that your money is allocated across all parts of the world. Why? So that you're not only holding stocks in companies or countries or whatever that are making war. We at least give you some ability to hold stocks, bonds, and so on in countries that are largely peaceful, be it New Zealand or Brazil or Switzerland, right? Etc. That's our goal, is to give you a full global portfolio so that you also receive what I would call a peace dividend. And right now, our results are showing that we are pursuing a prudent strategy that is producing results, and not just results, but we're outperforming our benchmarks. Again, I cannot tell you, it could totally turn around, and I always say that. I don't ever want to get a big head. We're getting good reading that we're doing a good job on the portfolios. Okay, any more questions? Catherine, anything else?
No, I think that was
That's it?
mostly it. Yep.
Okay, everybody. Thanks for hanging in. I know we run a little bit over today. I do want to say, as to surveys, thank you everybody who took the time to respond. I didn't put this on the housekeeping, but I'm going to say it now. Responded to our annual performance survey. Thank you so much for it. If you have not, just a gentle request that if you have 10 or 15 minutes, it really, really does help us. We make a $20 donation to a charity. You can pick off a list or name yours. It's really the way that we can hear back from you, and you can tell us what we're doing well, where we need to make some improvements. We take it very, very seriously. And if there's anything about this webinar that we can improve upon, or you want to just give us some reinforcement that it was helpful to you, we appreciate that too. I want to thank everybody for taking the time today. I want to thank Jaycee for her very, very important role in the webinar. And I want to thank Catherine and Daisy for putting all the logistics together and for conducting the webinar. And of course, Casey, who keeps us running in our administrative area so that we can do these webinars, right? We have to run a business at the same time that we're putting them together. And everybody here does that and makes sure that we are able to continue running our business on a day-to-day basis. So thank you, and have a wonderful rest of your day.